Everyone loves a good confidence headline when the economy feels uncertain. If a report says confidence improved even slightly, it sounds like relief. It feels like maybe the tension is easing, like people are finally breathing again, like something has quietly turned in the right direction. But confidence headlines can be dangerously comforting when they are read too quickly. Because sometimes people say they feel a bit better while the deeper parts of the economy are quietly getting worse. And that's what makes this moment so strange. On the surface, people say they feel slightly more confident. Underneath that, jobs are softening, hiring is slowing, and expectations about prices are starting to rise again. That contradiction matters more than it seems. Confidence is about mood. It captures how people feel right now or what they expect in the near future. But jobs and inflation are not about mood. They shape what people can actually do. They determine whether households feel secure, whether businesses expand, and whether spending continues. And when those harder signals begin to weaken, a slightly better headline can become misleading instead of reassuring. Because the real question isn't whether people feel a little better. The real question is whether the system underneath is strong enough to support that feeling. The modern economy has made this gap even more confusing. People are constantly exposed to information, markets moving, headlines shifting, narratives changing every week. That means confidence can improve quickly, sometimes even without strong reasons. A short stretch of calm news, a rebound in stocks, or even simple emotional fatigue from bad news can lift how people respond to surveys. But that doesn't mean conditions have actually improved in a meaningful way. It just means people feel less negative than before. And that's a very different thing. Jobs are where this illusion starts to break. A strong economy doesn't just feel stable, it behaves stable. It creates opportunities, keeps hiring active, and gives workers flexibility. But when job openings begin to slow and hiring becomes more cautious, something shifts beneath the surface. It doesn't always show up immediately in unemployment numbers, and it doesn't always make headlines right away. But it changes how secure people actually are. It reduces options quietly. It turns a confident job market into a careful one. And that kind of change is subtle at first. People don't suddenly panic, they adjust. Employers slow down new hiring. Workers become slightly more cautious about switching jobs. Businesses start thinking twice before expanding. It's not a collapse, it's a cooling. But cooling matters because it removes the safety net that strong labor markets provide. When that net weakens, even small economic shocks feel bigger than they should. At the same time, something else is happening that makes the picture even more complicated. Inflation expectations are starting to move upward again. This doesn't mean prices are exploding immediately. It means people are starting to believe that prices might stay higher for longer. And that belief alone can change behavior. When people expect higher prices, they adjust how they spend, how they plan, and how they negotiate. Businesses do the same. They prepare for higher costs. They adjust pricing decisions earlier. And that can keep inflation pressure alive even if it had started to ease before. This is where the contradiction becomes powerful. People say they feel a bit better, but at the same time, they expect prices to stay high and job conditions to become less certain. That combination doesn't create a stable environment. It creates a fragile one, because confidence built on weak foundations doesn't last. It shifts quickly. And when it shifts, it can move in the opposite direction just as fast. The economy is full of these moments where surface signals and deeper signals don't match. Confidence surveys are one of the most visible examples because they are easy to understand and easy to report. But they are also one of the most misunderstood. A small improvement in confidence doesn't mean people are suddenly secure. It often just means they feel slightly less uncertain than before. And when that feeling runs ahead of reality, it can create a gap that eventually has to close. That gap is where risk builds. Because if hiring continues to soften, if job openings continue to shrink, and if inflation expectations keep rising, then the underlying economy is moving in a different direction than the headline suggests. And when those two directions diverge, something has to give. Either the fundamentals improve to match the optimism, or the optimism fades to match the fundamentals. For businesses, this creates a difficult environment to navigate. On one hand, customers might still be spending, still expressing some level of confidence, still behaving as if things are manageable. On the other hand, cost pressures remain, hiring becomes more uncertain, and future demand becomes harder to predict. That combination doesn't encourage aggressive growth. It encourages caution. And when enough businesses become cautious at the same time, it slows momentum across the economy. For households, the experience feels even more confusing. You might say you feel okay. Maybe things don't feel as chaotic as before. But at the same time, your bills aren't really getting easier. Job opportunities don't feel as abundant, and the sense that prices could rise again never fully disappears. That's not true confidence. That's something closer to temporary relief mixed with underlying concern. And this is exactly why these headlines can feel misleading. Not because they are wrong, but because they are incomplete. They capture a moment of emotion, not a full picture of reality. They show a small improvement without showing the conditions that might undermine it. And when those conditions matter more than the mood itself, the headline can give a false sense of direction. This also has implications for policy. Central banks and economic decision makers don't just look at how people feel. They look at what is happening beneath that feeling. If inflation expectations are rising again, that becomes a problem regardless of whether confidence has improved slightly. If hiring is slowing, that changes how sustainable growth looks moving forward. And those factors carry more weight than a temporary lift in sentiment. That means decisions about interest rates, economic support, and policy direction are more likely to follow the harder data than the softer signals. Even if confidence looks better on paper, rising inflation expectations and weaker labor conditions make it harder to justify quick changes. And that creates another layer of tension. Because people see improving headlines, but policy remains cautious. And that disconnect can feel confusing or even frustrating. What makes this moment especially important is that it sits right in the middle of transition. The economy is not clearly strong, but it's not clearly weak either. It's in between. And in that space, small signals can be misleading if they are taken too seriously on their own. Confidence can rise without stability. Jobs can weaken without collapse. Prices can feel under control while expectations quietly drift upward again. And when all of those things happen at once, the story becomes less about any single data point and more about the pattern they create together. Right now, that pattern doesn't point to a clean recovery or a clear slowdown. It points to something more uncertain, something where people want to believe things are improving, but the structure underneath hasn't fully caught up yet. In the end, confidence headlines tell you how people feel, but the economy is shaped by what people can actually sustain. And when those two things don't match, it creates a kind of tension that doesn't resolve immediately. It builds, it lingers, and eventually it forces the story to reveal itself more clearly because feeling better and being better are not the same thing. And right now, that difference may matter more than the headline itself.